Hey everyone, trying to do more of these quick value videos to go along with the write-ups that I'm doing. This week I looked at Canal Plus. Let me come over to the article here for a second. There it is. So this was a recent spinoff from Vivendi, and this trades in. I hope I'm saying the name. Hope I'm saying the name right. This trades in London. They report in euros. So there's some math that you've got to do when looking at the results, and then they're buying a company that reports in South African rand. So there's a decent amount going on here, and people are trying to figure out what they've got. So I think that's why it's trading around 200 pounds right now. I think that's why it's hanging around where it is. It looks pretty cheap on the surface. We come over to my tables here. So in euros, about a 2.4 billion market cap today. I've got enterprise value around 3 billion, so that's the net debt that they inherited at the spinoff. And here's your EBITDA. That's their preferred reporting metric, not EBITDA, but EBITDA. So they're including depreciation in there. I think depreciation is something like 150 million a year. So you can back into an EBITDA number. So it's pretty cheap, right? It's pretty cheap. But the big thing that's going on here, and let me back up. Sorry, this is a French media business, so like a content producer, right? They're cable TV, broadcast TV. Most of the revenue comes from subscription TV, linear and digital, and then they've got some ad revenue as well. So I don't know, pretty plain vanilla content media business, like a Warner Bros, like an AMC Networks kind of model. Okay, so they completed the spinoff, and shortly after that, well, no, I guess they haven't yet closed on it, but shortly after that, they said, okay, we're gonna acquire the rest of this equity investment we've got. So they have a portfolio of equity method investments that sit on the balance sheet. One of them is this multi-choice, all right, and this is a Southern African media business, so similar business model. They owned 45% of it as of June, and they're buying out the other 55%. So they'll wholly own this thing, consolidate it, and that's going to cost them some money, and they're going to borrow money to be able to do that, and then they're going to inherit all those financial results from that business. So like all of the spin info and the prospectus info is only giving you like one piece of the full picture. So what I try to do is take the historic information, layer on multi-choice, and say, what is that going to look like? So starting with their 2.4 billion market cap, the 600 million of net debt that they've got. If you want to give them credit for the other equity investments, that's let's see, these two stakes here, right? 37% in this company, 29% in that company. I just pulled the numbers straight from here. You can. I normally wouldn't do that. It would just like separately add that value, but we'll include it in the EV here. All right. I assumed at the current exchange rate of the South African rand to euro that they'd be inheriting 330 million of debt from MultiChoice, and that it would take 1.6 billion to go buy the rest of that stake. I think my numbers are spot on here, but tell me if I'm missing a piece. There were 442 million shares outstanding. They own 200. Got to buy 242 at 125 ZAR per share, which works out to, I just rounded it up, 1.6 billion. All right, so we got a new EV of 4.5 billion, right? Well, we got to go. So they just added, what is that? That's almost 2 billion of debt to go out and complete this acquisition. So this is a pretty significant acquisition right out of the gate, right? So this is a very, very, very different company than what it was from just the prospectus for the standalone business. Okay. So here's all my tables, and we've got standalone Canal here, right? And I'll walk through the revenue mix. The cash flow is a little misleading because I didn't take into account the changes in the capital structure. So here's the actual financials, right, for 23, 22, 21. And here's interest expense, right, as one example. So 21, 22, 27 to 30 million, 158 million at 2023. I mean, that's pretty significant. I mean, that's what, even after the borrowed money that they pulled in to acquire MultiChoice, that might be the pro forma interest number. So this is going to skew the cash flow that you see in this document because all the previous debt was, back and forth between parent co and subsidiary. So net cash, right, 500 million net cash in 2023, but again, that includes that 158 interest expense as part of the as part of this net income figure. CapEx 300 plus million a year, so this is a pretty capital intensive business. So yeah, I mean, free cash flow is what it is. 200 200 million a year, right? I think that's maybe ballpark what you'd expect. Here's the figures, just pulling their standalone segment financials going all the way back to 2017. Here's the number that I came up with, right? So call it 200 plus million euros per year. There's your revenue mix. So very, very heavy exposure to France, and very soon they'll have heavy exposure to South Africa. I think I outlined it in the article what the pro forma mix is going to look like. We'll get to multi-choice fundamentals in a second. Hang on, where is that? Okay, here we go. I think this will change the revenue mix to 45% coming from Africa-Asia region, 33% of revenue coming from France, and then the remainder from European countries. So you're really getting just those two markets when you're buying this business today, France and Africa / Asia. I didn't dig deep enough to see what the breakout between those two were. Okay, so you're staring at that. Multi-choice fundamentals. Let's take a look at this. Right, so this is what I converted all the historic info using one exchange rate. So I didn't go back and say, what's the exchange rate in 2020, blah, blah, blah. So this is all at, I think 0.052 was the number that I pulled this at. So that's just a couple days old. 2.7 billion-ish, 2.8 billion-ish in revenue, and EBITDA for this business is falling pretty substantially. More free cash flow than even what Canal was doing historically, but in recent, I don't know, what is that, 18, 24 months, is falling pretty hard, right? So they're paying up at a time where this business is kind of going in the wrong direction here. So on a combined basis, here's what that looks like. Hang on, let's pull that over. On a combined basis, this is what you're looking at. 9 billion combined revenue, right? Under 1 billion in combined EBITDA, and free cash flow around 300 million. Again, this is all just using old historic. I just combine their number and their number, right? So no adjusting for pro forma capital structure or anything like that. And converting that to it's trading on the London Exchange, converting that to pence, it's about 25. I don't know if that's pounds or pence per share. On a 200 price, so you can do the math on that, right? 200 divided by 25, so call it 8x, right? Without adjusting for any pro forma cap structure or anything like that. So that's the backdrop, right? That's what you're looking at. The prospectus for the spin was this. They bought this, and now you'll get this go forward. And I think from here, it's interesting if you're buying this where they're hitting close to trough numbers and you can get back to this, that makes this pretty interesting, right? Because I think you'd have significant free cash flow upside from here at a really cheap multiple. You're basically paying a low multiple on this much, much, much lower number, but how much worse are results going to be? So where is this? You can pull up, they've got slide decks for multi-choice, and these are really helpful actually. And they show, at first I thought, oh, it's an emerging market. Maybe this is, a much better growth market than what you see in developed markets. But they're facing the same trends globally, right? So linear TV down, digital OTT up, right? So they're trying to find that same crossover point in the linear to OTT cycle. The FX impacts here has been huge, right? So they're sort of getting crushed with that. And this has all sorts of good charts. And they issued a trading statement that was really interesting and kind of revealing. So interim trading statement for 6 months, September 30th, 2024, right? And they updated their guidance, and here it is. But they talk about negatively impacted by severe pressure, macro, FX, and consumer, right? Especially in Nigeria and Zambia, which are two big markets for them. So there's a $2 billion cost saving program that's going on at the moment, and then in a later paragraph, this was super telling, right? they described it as the most challenging operating environment in the group's history. So, and at the same time, they're entering a peak investment cycle of one of their businesses. So, um, it just sounds really challenging market environment for them in this business in this market. So, I don't know how where they're at in that process, right? Are they troughing? Are they near trough, right? But I think that's a key part of this investment thesis right now is like, is it going to continue to get worse from here? So, okay, um, put those two pieces together, right? That's what you get. There's your combined free cash flow number, 300-ish million. Again, adjust for capital structure. I think I did that math in here, right? So pro forma business, I said, okay, add the 1.6 billion of debt, and I just took a swing at it. I said, all right, TTM 760 million EBITDA. I said the 300 million depreciation is probably a good proxy for cash or capex. Maybe that's off base. I don't know yet. Maybe there's some cost savings between capex on the two businesses. 250 million interest. I kind of pulled this out of my butt, honestly. I just said, all right, 1.6 billion times 5, 6, 7%, and then add on the interest that MultiChoice was already paying. 30% in taxes. I think the tax rate in both of these regions are in the 25% range, but just to be conservative, called it 30. So again, my estimates could be way off. This is just a starting point. 350 million earnings, $30 a share, 200 share price at 6.7, less than 7x PE, right? Again, if that's trough numbers, and if my estimates are even slightly close, and they could be way off. But really, where it's interesting is if they're operating at trough and there's a turnaround in any of those results back to those pre-COVID levels, then you could be looking at $44 a share or less than 5x earnings. Huge caveat, right? I mean, this is an industry that most people don't look at the multiples on AMCX and Warner Bros. Right now. Like, nobody likes this industry. So I think this might be trading at a pretty fair, reasonable price at the moment until people figure out what they've got and what the outlook is from here. So I just said, all right, I ran a screen. I said Johannesburg Index, stuck with just telecom and IT stocks, median multiples 10x. So using $30 a share at 10x, you got 50% upside. I mean, I don't know if that's really what it's worth, but that's just a starting point. So I think you got to figure out what the outlook is from here. It's probably trading at a reasonable price until like, all right, what's this business going to look like a year from now, 2 years from now, and if my capital structure / pro forma adjustments for free cash are in the ballpark. They held a capital markets day recently. This is just a video replay. I left some resources down here. I have not watched that fully yet. They didn't post the slide deck as like a standalone thing, so I think this is worth reviewing to see what's this upside situation look like. But consider this a moderately levered business, tons of emerging market exposure and exposure to France, and an unknown level of pro forma free cash post spin. So that's what we're looking at here. Kind of an interesting stock. Looks like upside optionality, again, is how I would describe something like this. So I'm going to keep it on my watch list. I want to see what the first set of results look like post spin and see what they have to say on the next earnings call, and then I'll probably take it from there. Leave a comment. Let me know what you think. Let me know if I'm missing anything by a wide margin, because my estimates are pretty fast and loose with this one. So not investing advice, by the way. Do your own work. I don't own shares in this. I just think it's an interesting looking stock with some upside optionality. So leave a comment. Let me know what you think. Thanks for reading.